JPX Energy Market weekly updates. The oil market continued to trade in large intraday range and is struggling to find direction during this period of uncertainty for both supply and demand. After a heavy sell-off last Monday, crude oil prices recouped almost all the losses. Inbound spread of major crude oil benchmarks also settled higher. The market took comfort in a season of COVID cases in Shanghai, China last week. However, there are more signs that we're seeing demand destruction at these higher prices. Nonetheless, the persistent threat of escalation in the Ukraine war, as well as the possibility of further sanctions by the West, might keep a floor under oil prices for now. We have a number of new data releases last week, including the IEA, EIA, and OPEC's monthly oil market reports. On the demand side, growth projections for this year have been revised down by the three agencies on a more temporary economic expansion and high prices. The IEA have revised down global oil demand growth projections for this year by a slight 70,000 barrels per day to 1.8 million barrels per day. While most of this year's expected growth took place in the first quarter of this year, demand will be 230,000 barrels per day lower than in the fourth quarter of last year as the economy slows and the impact of high prices bite. China's demand for this year has been revised down slightly, but demand for the second quarter has now been revised down by a total of 890,000 barrels per day across April and May reports because mobility restrictions stifled commerce and left air traffic close to its April 2020 low level. However, the latest trade data from China shows that despite the heat seen in domestic demand due to lockdowns, crude oil imports over April increased 4% to average 10.5 million barrels per day. We'll have to wait until later this month for more detailed trade data to see where this increase in flows originated from. It's also worth noting that global middle distillate, including diesel and kerosene crack spread in major trading hubs, increased substantially since the start of this year. In Singapore, lower refinery runs in China, as well as lower export quotas, constrained regional petroleum trade. U.S. refinery activity in April also underwhelming, with operational issues and tight available capacity leading to a counter-seasonal fall. Russia's supply have also declined as a result of sanctions. This drop, combined with lower refinery run rates over the period, has reduced a tight distillate market. In the short term, as summer driving escalates and jet fuel continues to recover globally, world oil demand is set to rise by 3.6 million barrels from April to August, according to IEA's forecast. Demand growth and rapidly depleting inventories have led refinery margins to unprecedented levels across all regions and configurations. From the seasonal lull in April to the peak in August, IEA expects a strong ramp-up in refinery activity to fill the product supply gap. Global throughputs are forecast to rise by 4.7 million barrels per day, helping restock depleted product inventories in the third quarter of this year for the first time in 2 years. The increase will come mostly from China, Europe, and the United States. The OPEC and EIA have revised down their global oil demand outlook for this year by 200 and 300,000 barrels per day respectively in the latest oil market report. But even with the demand drop, the forecast decline in Russian liquids production lifted the coal on OPEC crude to 29 million barrels per day for the year. Breaking down the coal on OPEC, the estimated need for the group's crude is expected to rise to 30 million barrels per day by the fourth quarter from 28 million barrels per day in the second quarter. According to IEA's data, world oil production fell by 700,000 barrels per day to 98 million barrels per day in April. That's the biggest monthly loss since February last year. Russia shut in nearly 1 million barrels per day, and production from other OPEC Plus members continued to disappoint, with total output from the bloc down more than 1 million barrels per day. The declines widened the shortfall between the bloc supply versus official targets to around 2.7 million barrels per day compared to 1.3 million barrels per day in March. The overall global decline was partially offset by higher non-OPEC supply, which rose by 380,000 barrels per day, led by strong gains in biofuels and a modest production increase from the United States. And the risks are rising that the United States will impose secondary sanctions on Russian oil customers, and a new sixth round of European Union sanctions still under negotiation could also affect Russian supply. Lastly, let's take a look at the intermarket spread. The spread between JPX Dubai and ICE Brent largely remained range-bound during the last 2 trading weeks after found support at a high level in April. In April, the spread between light and sweet crude oil grades and those with heavy sour grades narrowed compared with March globally. The effect of sanctions and self-sanctioning by many crude oil buyers has contributed to less availability of these medium sour grades, contributing to high prices. However, in the short term, all light and sweet crude grades in Europe have been racing higher because of maintenance work in the North Sea from April through early July and the lack of Libyan export, as well as record product cracks. but a rebound in China's demand and an escalation of Russian sanctions could lead to further upside risk to the spreads. Okay, that's all for this week. For more information on the energy market, please stay tuned for JPX Energy Market weekly updates.